Bloomberg Audio Studios. Podcasts, radio, news.
Bringing in now Mike Wilson, the chief U.S. equity strategist at Morgan Stanley, as we continue to monitor a market that shows no sign of stopping when it comes to setting records at the index level. Mike, good morning. We just heard from Karen, 46th record of the year for the S&P 500, despite all the risks that we talk about throughout the year. What are you looking at this morning as we watch this market continue to trade at record highs?
Yeah, good morning, Nathan. Well, look, I mean, this I guess was our bull case that we laid out back in May in our mid-year update. This isn't necessarily a popular view, but we believe we remain in this fiscally dominant world where fiscal policy remains very generous, and they've found ways to finance that in a way that does not disrupt the bond market, so that liquidity is very robust and multiples continue to expand. I think one thing that doesn't get discussed much is that almost all of the, return in the last year has been driven by multiple expansion as opposed to higher earnings revisions. Now we've rolled forward earnings revisions, but, generally the earnings estimates for 2024 have come down this year, and they're starting to come down now for 2025. But hey, who am I to say that the market's overvalued? And, the thing that's really going on now is we have coordinated, or I don't know if it's coordinated, but we have basically most major central banks are now easing policy. Even the Bank of Japan has kind of backed off its tightening campaign after the wobble we had this summer. And now we have China joining the party with its own policy initiatives, both on the monetary and the fiscal side. So it's a policy-driven rally. And it's very robust, and it's even broadening out now. So multiples are now 22 times at the index level, which you've only seen a couple times in history. But that will continue until basically either you get a real shock on the economic front, or, fundamentally speaking, or you get a restriction on the liquidity front. And just one last statistic there. So we look at money supply growth globally in U.S. dollars, so U.S. dollar liquidity, and that bottomed, almost 2 years ago, and is now growing again very robustly at about 8%, and it's really shot up in the last month and a half, and that's mostly due to China and Japan starting to expand their balance sheet and the weaker dollar. So one other thing that could cause the rally to kind of slow down is that the dollar were to strengthen again. And that's starting to happen. So that's probably the one thing that we're watching now that could kind of throw a wrench into this pace of the new records every day.
To take your point, Mike, about whether this is a fiscally driven rally, does that raise a question for you about whether things could change depending on the outcome of the election next month, whether fiscal policy could change depending on Kamala Harris or Donald Trump becoming the next president, or a change in power on Capitol Hill?
I don't think so. Neither party has really shown any, willingness or ability to slow the freight train on fiscal spend. I think the bigger concern is how do they fund it? And they've been very creative over the last year and a half. Of course, people have talked about the reverse repo facility. We've discussed that at length. I think that was a very creative way to help fund the government. They've funded it at the front end. And for now, the bond market seems to be okay with that. I don't know if the election is going to be the trigger for why all of a sudden the bond market, starts to worry about the sustainability of these fiscal deficits. Okay, I don't think there's a big difference between the two candidates or congressional who's running Congress to say that that's going to stop. I think the big risk, as it typically is when the bond market starts pushing back on the size of these deficits. And that, who knows what that'll be. And maybe they can pull it off. Maybe we can inflate our way out and we can get better growth next year. We'll see. But that's the game that we're playing. And right now that's a bull market.
In the time we have left, Mike, I want to get your view on earnings season, as well as the focus is going to turn back to the big banks and the idea of companies raising their guidance a lot more than a lot of strategists, at least according to Bloomberg intelligence data, are predicting here. Is Wall Street underestimating earnings, or are the companies overpromising? Got about a minute left.
Probably somewhere in between. Historically speaking, bottoms-up estimates do come down over time. They manage those earnings. We're seeing the same thing in the third quarter. This season, earnings have come down significantly. But as you roll forward, the market kind of looks past that. So, we're probably slightly below, estimates for the fourth quarter as well as for 2025. I don't think that's wildly out of consensus, although I think we're below the street in terms of top-down forecasts. But look, as long as earnings are growing and there's liquidity, I don't think that necessarily derails us. What we think is the most interesting thing to be talking about, forget the index, is what's going on under the surface. We had been overweight defensive stocks most of the year, and that worked out extremely well. We downgraded that about 3 weeks ago, and then we upgraded cyclicals a week ago. And that probably is where we're spending most of our time, is trying to find out how to beat the S&P 500 rather than trying to figure out the direction of the S&P 500. And right now, it's cyclical stocks are having a bit of a rebound, led by financial, some of the industrial areas, and maybe even some of the commodity space. Mm-hmm. So that, to me, is the story now, is like, what do I own, not how much do I own? And right now, it looks to be the cyclicals are having a bit of a rebound.
Really appreciate your time, Mike, this morning. Thanks so much for being with us. Mike Wilson there, Chief U.S. Equity Strategist at Morgan Stanley.